So what's the big problem with wealth creation? How do people like us, who didn't inherit a boatload of money, who are investing and building wealth from our own blood, sweat and tears, how do we invest in a way that gives us remarkable results and become financially free before retirement age? I don't know about you, but I am sick of hearing from wealth gurus and experts who don't walk their own talk and prescribe strategies that are a one-size-fits-all approach. For self-made people like you and me, I'm here to tell you that you don't need to be superhuman or already wealthy to reach financial freedom earlier than 65. This is the Alternative Investing Podcast. Hey guys, welcome back to the podcast. It is awesome as always to have you tuning in. Today I'm doing something a little different. I'm recording this podcast in the afternoon, which I don't normally do because I'm not at my freshest. But I wanted to record this because I just received yet another email about this topic, and I think it's time I actually put my mouth to the speaker and actually pumped it out. So I want to tackle this idea of 10 biggest lessons associated with my journey around investing in alternative real estate. And the reason I want to share this with you is because I think it's a great catch-all for a series of questions that I've been getting lately, and I've actually started to write them down on whether or not it's actually a good time to be focused on alternative investments, which I definitely in a nutshell think it is, but I want to explain why. For those of you who don't know me, I've been investing in alternative investments for the last, I'm going to say almost 14 years now, but I want to kind of re-emphasize what alternative investments are and what they're not. So as I've said in a number of other podcasts, unfortunately, when you use the word alternative, it conjures up all sorts of scary, hair-raising, high-risk investments. But essentially, those certainly exist in the alternative space. But when I talk about the sorts of investments that I'm interested in, they are investments backed by real property. And even more narrow than that, it is predominantly deals which circle around that affordable housing piece. So they sit outside of mainstream purely because of the creative way that these deals are put together. They definitely sit outside of mainstream, and access to premium opportunities in this particular environment are very much a private playground. So they include things like syndications, small funds, lending opportunities where you get to be the bank, direct property ownership in the form of turnkey and joint ventures. So the purpose of today's podcast isn't really to go too deep on any of those things, but I want to kind of really emphasize when I talk about alternative investments and my experience with them, I'm not speaking about things like venture capital, blockchain, seed capital, all that kind of stuff. I'm really talking about these real estate backed deals where, just from a safety and risk perspective. So what I really want to talk about today is some of the lessons that I've gleaned and why as an asset class, and they really are a distinct asset class, they are so powerful when it comes to building wealth rapidly. So lesson number one, I'm going to articulate it as that they shave years, if not decades, off your timeline to financial freedom. Now, this was a lesson that probably took me a few years to wrap my head around, but essentially the big problem with traditional assets, whether you're talking about shares or traditional property as we know it, is that they are epic for building capital and absolutely rubbish for generating income streams or cash flow. And I was doing all of the right things, hustling, redlining through to about 2008, 2009, when I realized that even though we had quite a large portfolio of real estate property, we were still decades away from generating any kind of meaningful cash flow. And that was the point in time where I started to go, look, this just isn't working. What else exists out there? What I realized is if you can combine traditional investments, which are great for building capital and net worth, and combine those with this alternative investment pool of assets, which are epic for cash flow, strong, predictable cash flow, that's when you can really explode your results and massively compress the timeline that would otherwise take you to reach financial freedom. And in my own instance, I would say, I think when I did the math in 2008, we were probably at least 25 years off having the sort sort of cash flow that I wanted. And by adopting a very small fraction of our portfolio and moving it into alternative, I realized that the timeline could, really scale back to sub 5 years. So it's really important to understand that the place of alternative investments is to really help you ramp up the cash flow as quickly as possible. So that was the number one lesson. And certainly most of the people that I work with now are already investors who are seeking to simply resolve the cash flow piece. Perhaps they are already at a reasonably good net worth, but they just can't solve the cash flow compartment side of things. So that's one thing. Lesson number 2, they have a lower risk profile. So the lesson that I learned around risk was an interesting one, because again, it sort of revealed itself very slowly. So what I know is that in volatile times, these alternative investments still thrive and they're still stable. So back in the day when I first started an alternative, I focused on turnkey, meaning assets where I had direct ownership of an individual single family home. And one of the things I noticed almost immediately, especially because I was, I started my journey during the global financial crisis, during the peak of the global financial crisis. And what I knew was that you could acquire real estate at cents in the dollar, particularly in the US market, where valuations were trashed. There were just millions of foreclosed properties and the banks were just offloading them at whatever they could get their hands on. So in spite of the fact that property valuations were smashed, absolutely nothing happened to the cash flow. So what that meant was, obviously, if you bought cheap or affordable houses at a discounted rate, you could actually get a much higher rate of return. And so also what I witnessed is that in the markets that I, predominantly focus on now, you don't get those mad fluctuations in valuation either. You don't get massive appreciation, nor do you get massive depreciation. And because you are purchasing for cash flow, any drop in asset values, because, that could happen, have much less meaning. And I prefer those markets with low volatility because I'm focused on those affordable housing sectors of the market where there are tons of buyers and tons of renters. So from a, recession resistant perspective, there are always going to be plenty of people available to, participate in as renters in those kinds of deals. So when I marry that or compare that against the markets that, we know, love and trust here in Australia and New Zealand, for example, I know that we are banking on a rising market, meaning if the market doesn't rise, we lose because we're not getting cash flow, we're buying for growth. And the contrast is with alternative is regardless of whether you're buying for growth or income, you don't care which way the market moves because you're either buying for cash flow that exists today or you're creating growth through forced appreciation rather than organic capital growth. So if you marry that up, I'm giving you the high level here, obviously, but if you add all those elements up, it kind of contributes to, in my opinion, a lower risk profile than buying an asset where you are hoping and praying that the market rises over time. Not to say that that isn't a valid strategy, and certainly investors who are really just trying to get some traction, and I've said this a million times before, you have to start there. But ultimately, as you start to build your net worth, you build your capital base, then things like alternative become much more meaningful. The third lesson that I want to share here is relationship capital is the real gold. I feel in our market, there is an entire network of wealth advisors, financial planners and alike, who kind of try to position themselves as the expert, and therefore this concept of relationship capital is often overlooked. And, if I think about my own journey, the point in time where there was a huge inflection in my results was when I started to recognize that building relationships, not just with one person, but with many skillful investors, was really the difference that made the difference and really catapulted my results. So if I look back at, times where I've lost money, it's because I relied on the wrong people in the wrong markets. And the journey that I've been on is, how do I continue to ratchet my way into better and better quality private networks so that I can curate better and better deals with lower and lower risk? I don't even know if that's grammatically correct. I think if I really reflect potentially even mostly on the last 6 or so years, I've started to kind of really articulate that who you know matters more than what you know, that the single biggest risk in investing is who you align with, and that the better deal makers are super private and move in circles that are generally not available to the public. And why I love trying to find these people and work with them is you get to leverage the decades of experience that other people have. You get to be totally passive in A-grade deals. And ultimately, as an investor, if you really truly want to be diversified, both in terms of your trusted advisors, the deals you do, the markets you're in, the styles, the strategies of investing, the liquidity points, you can't do it with one person. That just isn't possible. So one of the things I strongly encourage people to consider is valuing the who. Relationship capital is grossly undervalued. I genuinely believe when I set up to start Freedom Warrior, I really, what I was trying to do was cultivate this idea that a mastermind where it's not one guru, it's many, is a much better model for wealth building than trying to go to one educator, one trusted financial planner, one wealth advisor, and expect them to be your one-stop shop. It just isn't conducive. It's just not possible. There isn't one person out there who has all the answers. And I think the minute you can wrap your head around that and start to look for how do you leverage access to a panel of epic, amazing investors, that's when your results will actually start to reflect that transformation. So that's a really, really important one for me. Lesson number 4 is you must have investing rules. So I know that actually sounds really obvious, but regardless of whether you're a share person or a property person or alternative investing person, not having investing rules really effectively makes you opportunistic. And being opportunistic kind of can get you by for a while, but it cannot get you consistent results decade after decade and without potentially exposing yourself to unrequired losses. So, you're leaving more to chance if you don't have investing rules. And so if I were to articulate how my own rules have developed, unfortunately, in many cases, it's been through poor experiences, through loss, through, learning, won't do that again. But effectively, my set of investing rules could in theory be applied to any asset class. And the investing rules that I have eliminate emotion because, at the end of the day, if you read investment books published by prominent investors about how they've built their fortunes or their empires, essentially the biggest demon you have to deal with as an investor is actually emotion. People think it's about the deals. People think it's about how to pick, the investments. And that is clearly a part of the equation, but your capacity to manage your psychological state and your emotion is probably the bigger contributing factor. Knowing when to stay out of the market, when to jump in, all that kind of stuff. It's about managing your emotion. And what rules effectively do is cap the amount of emotion that goes into your deal selection. It reduces the risk of you being impulsive. And I know that as a younger person, as a younger investor, I was certainly often impulsive with choosing investments. And I think it's partly my nature, and I still have a tendency to be impulsive, in general. But, the other thing I feel about having a set of rules is that the rules should be adapted over time to make sure they continue to align with your goals. So one of the things I'm really conscious of is where I have a set of rules and I come across this very lucrative opportunity, but it doesn't align with my goals, my rules will tell me that. So there's many layers to this. And what I would say to you is you want to, review your investing rules every year and look for opportunities to refine and tweak them. But I would absolutely categorically tell you that having investing rules, it does sound really obvious, as I said before, but it's something that most investors will overlook. Lesson number 5, don't chase yield. So just to clarify what I mean when I say that is it's very easy, and I notice this a lot, especially with younger investors, although I do see it a lot with seasoned investors too, is when they are contrasting deals or when they are looking for deals, they are simply looking for the deal that gives them the most profit or the most income. And, I think I've learned probably the hard way that when you chase yield often, and, referring back to my previous lesson on having investing rules, that's when things can come undone. So sometimes you can have two deals side by side that on many levels have equivalent characteristics that align with your rules and align with what you're trying to achieve. And yet you'll find that people will, I think, by nature, lean towards the deal that has the higher return. And so the reason that I say don't chase yield is that I think we can get into a habit, if you like, of looking at deals based on profitability rather than sustainability of returns. And so my advice and my mantra that I give a lot of people is don't chase yield, focus on sustainability of returns, always be quantifying risk in the background rather than looking for the flash in the pan, looking for the gold. And if you refer back to rules again on this one, you have a whole bunch of other criteria to satisfy, and the profitability of the deal is one of those criteria for sure. You may have a threshold that you go, well, I'm not going to do the deal if it falls below a certain level, and that's okay. What I'm really warning against and what I've learned is when I had two deals in front of me and maybe I pick one just because it had the higher return but maybe wasn't as well structured as a lower returning deal, that's when you can get into trouble. And if I were to give you an example, there are a lot of deals in the alternative investing space which I wouldn't touch with a 10-foot barge pole. Deals run by celebrities or pseudo-celebrities where they claim to be able to deliver 25% per annum cash flow returns. And that's very sexy, but when you contrast that with a lowly cash flow deal, which maybe gives you 10% return or 12% return, but has a super qualified, experienced deal maker that like and trust, that you can see how they will manage the risk on the project, that they are experienced, that they have a very narrow and deep focus, I will always now choose the sustainable returns over the sexy returns, because I know now that, yield by itself or looking at your return on investment by itself is a huge mistake. And I know that because I've certainly done that in the past. So I'm definitely not preaching from a castle here. Lesson number 6 is probably an obvious one, but I want to explain it, which is diversify your investments. So in the alternative investing space, as I said to you before, there are some amazing opportunities that people can present. And I have great skepticism around anything that seems unbelievable. What I would say to you is, and I've learned again this the hard way, is it is much more effective to take small bites of lots of cherries where you work with different trusted advisors in different markets, with different strategies, with different teams, different liquidity points, different timelines, different horizons, different tax benefits. And, some of those people might have a very deep and narrow focus, and others might have a very wide and diversified approach. But the idea is you don't expose a huge amount of capital to any one deal. And on the whole, you're hoping that, all of these deals go well. But there's, it's investing. If it was a sure thing, everyone would be doing it. So diversifying investments for me within the alternative space is, how do I take small amounts of capital and put them into many, many deals so that I do create a patchwork of strength and better security for all of my deals and all of my capital. And ultimately, if one of those deals goes wrong, I'm not going to die in a ditch over it, because I've still got plenty of other deals on the go that in other markets with other deal makers. So yeah, this is a really important one. And I think people misunderstand it, because when we think about diversification historically or locally, we think about, well, if I have a house in Sydney, then I should go and buy a house in Brisbane or Melbourne, and then I'm diversified. But diversification has so many more faces to it than just geography. And especially in alternative where you are completely passive, you are relying hugely on the management skills and investing skills of the person that you're aligning with. So it pays, just as an insurance policy, to spread the love. Number 7, be really clear on capital allocation. So what I would say to you is that I'm a huge believer in having your cake and eating it too. And when I say that, what I'm generally referring to is there's no harm in building wealth across multiple asset classes. What I would say to you is build the bulk of your wealth in an asset class that you feel really comfortable and confident about. Then take a percentage of that net worth to put it into alternative. So I'm not one to advocate that you take all of your money and put it into any single asset class, including alternative, no matter how amazing it is. And there are reasons for that. We want a fail-safe kind of plan to grow our wealth over time. And the best way to do that is to have a plan A, a plan B, a plan C, and a plan D. So in my case, for example, and I've shared this in past podcasts, plan A is our active income. Plan B is our alternative investment income. Plan C is the portfolio of local investments that we cultivate here in Australia. And Plan D is our superannuation, which is probably the most dull and boring out of the whole lot. So for me, understanding what percentage of my overall net worth I want exposed to alternative at any particular time is really important to know that number. For some people, it could be as little as 10%. For some people, it might be as much as 30 or 40, maybe even 50%. I guess my learning is that you want to be super clear on how you want your pie to be carved up so that you don't accidentally get swept up and put all of your eggs into one basket. So it's a kind of, I guess, to some degree, the 7th lesson here on capital allocation is going a little bit deeper on the diversification, but talking more about building wealth in the context of everything you've got. Because the way that I see it is if I can have a portfolio of domestic real estate assets that grow and give me a pretty decent hedge against inflation and have the cash flow coming in from my alternative, then I'm not really sacrificing one or the other. I'm kind of, as I said, having my cake and eating it too. Lesson number 8, build your investments gradually. So one of the things that people have often said to me, particularly higher net worth individuals, have come to me with quite significant cash balances that they just don't know what to do with, or they've got money tied up in assets they don't particularly like or that they can see are not performing. And the initial kind of tendency that people have is to want to kind of create an instant result. You know, they get the idea that, well, alternative investments are going to generate somewhere around the 8 to 12% net return after expenses for me, which is obviously just very juicy and exciting, but they want that result straight away. So the tendency is to want to take their lump sum of capital and dump it into investments all at once. Now, could you do that and still have a high degree of success? Possibly, but I think it's the accountant in me that wants to take a slightly risk-averse type approach, which is, I'm a huge advocate of you being educated on, what you're doing and, acquiring knowledge as you bed down each investment. So one of the things that I learned over the last decade or so, decade plus, is that regardless of whether you've got cash and capital sitting around that you want to invest, is to have the patience to build that portfolio gradually. You get to bed in an investment, be confident about it, then add the next one, then add the next one. So even when people have had multiple millions of dollars to put into alternative investments, I still am a huge advocate of saying just take small bites and build gradually. There's no need to rush to the finish line. More important is the access and the knowledge to know that you're going to get where you want to go in a relatively short space of time, but to take your time and allocate that capital very slowly. So I don't want to say too much more about that. Lesson number 9 is, and I learned this one definitely at least over the last 12 years, is invest in mentors. I would hazard a guess that I have spent hundreds of thousands of dollars in mentors along the way, both formal, informal, courses, education programs. And in particular, if I think more recently, I have one mentor who completely changed my outlook, speed and trajectory. Someone I met about 7 years ago. And I would say now that I've probably got about 5 or 6 people that I would tap on the shoulder and ask questions to, or who I would think of as mentors. It's the cliche, you get to stand on their shoulders. If you have a good enough relationship, they will share mistakes and help you cultivate a better set of investing rules. So sometimes I've invested with someone just to witness how they invest. I cannot even express to you the learning that comes from putting your money alongside a veteran that you know, like, and trust into a deal, and just watching how they digest information, how they run a deal, how they think about it, the questions they ask, the rules they have. To some degree, and I know that they're a horrible bird in the bird world, but I'm like a cuckoo. I think, why reinvent the wheel? Like, let me just borrow the brilliance of other people. I'm certainly not preaching anything in this podcast that claims that I've created it myself. But what I think I'm great at is assimilating the insights, views, and I guess learnings from, some super wise investors, and then putting it all together in one place. I feel that, again, culturally, we are taught that you should be able to figure this stuff out yourself. There's so much free information out there. But I know that where I've had the most significant inflections in my journey in terms of massive growth have been where I was prepared to pay the price and invest in mentors. Other people may not share that view, but for me, if you are someone who values time and you are looking for speed to goal, there's no other substitute. And, I contrast that with the other end of the spectrum, which is the do-it-yourself model. And I say this to people, like, you could get where you want to go for sure just by figuring it out on your own. And if you're a younger investor and you've got time on your hands, then that is absolutely the way to go. But as time becomes a more valuable commodity to you, as just needing the desire to hit some of those financial goals becomes more important, then paying for the right mentors and injecting yourselves into the right circles where, because not all mentors are paid mentors, that is what will change your trajectory and speed. And then finally, lesson number 10, and this is probably the most painful lesson for me to share, and it's probably more related to investing in general rather than just alternative. One of the things I've learned in great depth over many years is that losses from time to time are natural. I've had some very large losses in my early part of my investing journey, and they've been very difficult to digest at times. And I've certainly shared or swapped war stories with many of you guys who've reached out. But what I would say to you is that if you can get past a loss, if you can digest it, if you learn to manage risk, but expect from time to time that you might get a scratch, digest losses and try to glean the lessons, then you can still set yourself up for an outstanding result. And in fact, if you look at the life journeys of some of the most renowned investors in the world, I've read and discussed a lot of stories with a lot of people. What you'll find is that no one has smooth sailing. Everybody experiences a loss from time to time. But I guess the real learning is not to let one loss outweigh, your overall wins and gains that you're getting with the rest of your investing. I think as well, particularly if you adopt some of those other learnings that I've just mentioned, rules as well, of course, being fundamental. As I started to tighten up, then the mistakes have become fewer and less serious and minor scratches, if at all. So I guess the lesson is that, loss is natural, whether it's property development, share trading, alternative investments. But I think many of us expect that it's going to be all smooth sailing. And I guess the lesson I wanted to really reflect on is that, losses, whether they're material or immaterial, are natural. And the bigger lesson is around how you digest them and move on. So that is it. That is my 10 for today. Now, I probably could have had another 10 in here at least, but I wanted to just kind of put a nice neat bow on the 10 big ones. It's the first time I've actually tried to write down lessons in one place. And I certainly think there's, I hope there's some gold in here for those of you who are really looking for not so much the, what is the pathway to riches, but, how have I learnt from good and bad experiences? So anyway, guys, it's been awesome to have you tuning in. As always, please reach out if you have questions. If you are a business owner or an executive or anyone who is looking to accelerate their wealth creation through alternative investments, I'm definitely open to having a discussion, and I very much appreciate all of the kind comments that have been sent through in the recent months. Till next time, take care. So guys, thanks for tuning in today. That wraps up the 10 biggest lessons I've learnt investing in alternative investments over a decade. Hope you found that really useful. I am definitely starting to tune in to the questions that are coming in via email. If you are interested in understanding any aspect of alternative investing or understanding anything about my journey, please feel free to reach out to me on any of the socials or via email, Salena, Salena @inkosiwealth.com. Love to hear your feedback and very much appreciate you taking the time to tune in today. Till next time, take care. You've been listening to the Alternative Investing Podcast. If you're feeling frustrated that despite doing everything right in the property investing playbook and you're no closer to financial freedom, then head on over to inkosiwealth.com to learn more about how you can use alternative investments to catapult your investing income and blend strategies to shave decades off your timeline to financial freedom. See you on the next episode.